Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Currency exchange risk is a tricky topic that applies to several different securities you'll learn about for the exam, and in particular, foreign investments. When a currency exchange occurs, it adds an additional layer that influences the gains and losses of that investment. This risk is typically involved with direct investments in foreign securities, American depository receipts, and international or even emerging market funds, and even foreign currency options. Exchange rates fluctuate on a daily basis due to a number of factors that you, generally speaking, don't need to know for the exam. Before we discuss how currency exchange risk applies to securities, let's actually apply it in a personal example, and I think that'll help you understand the whole topic a little bit better. And by the way, there will be some calculations done in this video, but you most likely won't need to do these calculations for the exam. The test writers are more concerned with you understanding the idea of how the risk applies versus you actually being able to do the calculations that involve the currency exchange. Let's say that you want to take a vacation in Spain, and Spain is part of the EU, the European Union, and they use the euro as their currency. After calculating the cost of your hotels, your Airbnbs, food, and any of the attractions that you want to see there, you determine that your vacation is going to cost somewhere around 4,000 euros. Assuming that you're an American, all your money is in US dollars, and you will need to eventually convert those US dollars to euros to pay for those goods and services. Let's go ahead and take a look at the exchange rate over the last several years. If you exchanged your money in October 2017, one US dollar equaled 85 cents in euros. Doing a bit of math tells us a 4,000 euro vacation will cost $4,705 given that exchange rate. But what if you waited a little bit to take the vacation? By February 2018, the US dollar weakened, which means that it buys less of the foreign currency. At this point, one US dollar equaled 80 cents in euros. What we're going to find is that this is going to work against you because your vacation is going to become a little bit more expensive solely because of the exchange rate. So let's do another calculation. A 4,000 euro vacation, given that exchange rate, will actually cost 5,000 US dollars. Because of the exchange rate changing, your vacation got $295 more expensive. If the currency you're exchanging out of weakens, that will work against you, whether you're a vacationer or an investor. Now, let's see what happens when it actually works in your favor, and that would be if the US dollar strengthens. By February 2020, the US dollar strengthened to a point where one US dollar equaled 92 cents in euros. One last calculation we need to do for our vacation example. A 4,000 euro vacation given this exchange rate will cost 4,347 US dollars. The vacation got cheaper just because the exchange rate fluctuated. The bottom line here is that your international purchases are very much influenced in terms of real cost to you by currency exchange rate fluctuations. Sometimes it works in your favor and sometimes it doesn't. The same idea applies to investing in foreign securities. When an American investor considers a purchase in a foreign security, they must consider not only the exchange rate at the purchase, but also what is the future for that exchange rate? Will it work against them when they sell the investment and convert that foreign currency back to US dollars? Going through a quick exercise, let's assume an American investor wants to make an investment in a Japanese company that will cost them 200,000 yen. Now, real quick word of caution, the exchange rate for yen is going to look completely different, mainly because one US dollar will usually buy somewhere around 100 yen. And as of April 2016, one US dollar bought 108.75 yen. At that point in time, a 200,000 yen investment cost $1,840 in US dollars. By December 2016, the US dollar strengthened to the point where one US dollar equaled 117.90 yen. At that point, an investment costing 200,000 yen was the equivalent of 1,696 US dollars. The point to make here is that a strengthening US dollar is beneficial when making a purchase denominated in a foreign currency. It makes the security cheaper just because of the conversion rate. Now, let's reset real quick. By November 2020, the US dollar weakened to a point where one US dollar equaled 103.35 yen. At this exchange rate, a 200,000 yen investment would cost 1,935 US dollars. A weakening US dollar is a risk for US investors as they convert into the foreign currency because it makes the investment more expensive just because of the conversion rate. So real quick, let's summarize what we just learned. A strengthening US dollar is a benefit to US investors purchasing securities denominated in foreign currencies because they can purchase more of the foreign currency, making the overall investment cheaper from a US dollar standpoint. Versus a weakening currency is a risk for US investors if they're purchasing a security in a foreign currency, because their dollar doesn't go as far, making the purchase a little bit more expensive. Now, what if the foreign investment is made, the investor holds the security for a few years, and then decides to sell the investment? When the sale occurs, the sales proceeds paid to the investor will be paid in the foreign currency, and so there's one other exchange we need to be considerate of, in exchange from the foreign currency back to US dollars. Let's assume the original 200,000 yen investment grew to 300,000 yen, a pretty good investment return. Now, real quick, and ignore the timeline here because we're actually going to go back in time before the purchase was actually made. But the important part here is just exposing and looking at different conversion rates. As of April 2016, 1 yen equaled 0.009 US cents. Yeah, that's a little bit less than 1 penny. Therefore, a 300,000 yen investment would be the equivalent of 2,700 US dollars. By August 2016, the yen strengthened to a point where 1 yen purchased 1 cent in American dollars. Therefore, an investment yielding 300,000 yen would be the equivalent of 3,000 US dollars. So the point here is a strengthening foreign currency is a good thing for American investors when they sell their investment and convert back into US dollars. The investor receives more US dollars just because of the new conversion rate. Okay, let's reset one last time here. In December 2016, the yen weakened to the point where 1 yen was the equivalent of 0.0085 cents in US dollars. At that rate, sales proceeds of 300,000 yen would equal 2,550 US dollars. A weakening foreign currency is a risk for American investors when they're selling their foreign investment and converting back into US dollars because they get fewer US dollars when that occurs. Let's go ahead and summarize what we just talked about. A strengthening foreign currency is good for US investors when they're selling their foreign currency and converting back into US dollars. They receive more US dollars when that occurs. And a weakening foreign currency is a risk because they receive fewer US dollars during the conversion because the foreign currency is weaker. Before we try to bring everything we just discussed all together to look at it from a very big picture standpoint, I do want to cover one thing real quick. A weakening foreign currency is the same thing as a strengthening US dollar and vice versa. A weakening US dollar is the same as a strengthening foreign currency, just so you're aware of the language that we use. So here's the final conclusion. A strengthening US dollar, or another way of saying a weakening foreign currency, that is a benefit for US investors when converting their US dollars to the foreign currency. With a strong US dollar, also known as a weak foreign currency, the conversion results in more of the foreign currency obtained, therefore the foreign purchase is cheaper. Now on the flip side, this is a risk for US investors when they are selling their foreign security and converting back to US dollars. With a strengthening US dollar or a weakening foreign currency, that means the conversion results in fewer US dollars obtained when they turn the sales proceeds from the foreign currency back into US dollars. Now let's talk about a weakening US dollar, also known as a strengthening foreign currency. This is a risk when converting the US dollar to the foreign currency to purchase a foreign investment, because this means that the US dollar doesn't go as far, they buy less of the foreign currency, and therefore the investment overall is more expensive. But this is a benefit when selling the foreign investment and receiving the foreign currency sales proceeds and then converting back to the US dollar, because this means that more US dollars are purchased when that conversion occurs.